Frank Holmes, the CEO and Chief Investment Officer from U.S. Global Investors, joins us today. Frank, thank you for being here. We want to start with the mining industry. What's your overall sentiment? What's the overall sentiment regarding mining right now?
Well, it's very pervasively negative because of all the tariff war. But when we look at capital expending for durable goods, it's very robust. When we look at PMIs, they just came out today in Europe, they're also very robust. Copper's down 3 standard deviations, which means that there's the probability is about an 80% probability of getting a rebound. Gold is down 2 standard deviations. A lot has to do with the dollar, the surge in the dollar relative to the other countries' currencies. But what really amazes me is that the interest rate that they're offering you to buy a 10-year government bond in the US versus Japan, 10 basis points versus almost 300 basis points. So you would think that the US dollar should be surging even greater, and it's not. So I think it's very bullish sentiment. I think a lot right now is sentiment. If you believe in all the electrical cars and everything's gonna be electrical, then you should be long copper. Right. And I think that this tariff war is more headline news than it is gonna be truly reality of slowing down economic activity.
Well, that's some good news there. Have we reached a peak in gold?
Yes, we've reached a peak in gold. The frackers came along and there was peak oil. And so the frackers came along with the new technology of how to extract from sedimentary basins on land throughout Texas and Oklahoma and all through North America. That was the revolution, but there's nothing in gold mining. So the process, when we look at the cost for drilling for gold, looking for it, developing it, finally getting into production, and then when we look at any serious deposits, they're in high-risk countries, that emerging market countries, which have huge social problems. So what happens is that they keep moving the goalposts. Capital's not there. There's no money here. Take a look at the head of Bank of Montreal. He left to go and join to be vice chairman of Ivanhoe Mines. Well, why? Because the capital markets for mining finance are broken. So there's no money to develop these resources. And there's been no major discoveries. So anyone that's producing gold today is in a very sweet spot.
Good to know, good to know. You've recently written about the gold oscillator chart. Briefly tell us about that, and then we'll...
Well, the oscillator I mentioned earlier is what they call standard deviations. And what does that mean? It means a 70% probability. It is normal, just 70% of the time, gold can go up or down 1% in a day. It's just normal DNA of volatility. Gold stocks are 3%. So it's recognizing what is the DNA of volatility on a daily basis versus an annual basis. So what shocks a lot of people is the DNA of volatility of bullion over any rolling 12-month period is the same as the S&P 500, plus or minus 20%. So it's a non-event for gold over a rolling 12-month period to go up 20% or fall. It's when it goes up 40% or falls 40%, there's something material, and you get what's called the law of mean reversion. Things, as an oscillator would show, they're going to come back to this normal midline. And right now, gold is down 2 standard deviations. The dollar is up 1 standard deviation. And that means over the next 60 trading days, there is a 74% probability of gold rallying back to the mean. And that would probably tack on $50 to $100.
Very, very good to know indeed. Are you expecting the gold price to bounce here? Like that's what you're
exactly
saying, right? Yeah.
Just on the math of capital markets, going back a decade, the odds are in your favor that it will rally. Now something else can make it go lower, the dollar surges even more, but math is in your favor.
Good to know, very good to know. Now, speaking of favors, do us a favor and give us a few stock picks, some gold stock picks. I mean, you're the man with a gold phone, so we're asking the right person here.
Well, I think that the safe bet, if you're speculating or you're looking for a more consistent basis, it's the royalty companies. The royalty companies offer you high profit margins, revenue per employee. Would you not rather buy Franco-Nevada, giving you $20 million of revenue per employee, or where they have royalties on Newmont and Barrick, where the average revenue is $500,000 per employee? I'd take the 20 million. That's just my sort of efficiency ratio. So I think the royalty companies are just a sweet spot.
Good to know. Thank you so much, Frank, for joining us today.